Today, we're talking about buying pullbacks that actually work. If you want to buy a stock that moves in your direction when you buy it, the most important thing to focus on is key levels. Not the pattern, not a bunch of indicators, just key levels. But here's the thing. To make your buys truly work, you don't need any fancy strategy. You don't even need to know the name of any of these chart patterns. All you need to know are two very simple rules. I call this the power of two. The power of two is when two major key levels meet and what happens following that. These are a set of rules I use to buy pullbacks that work right away. And once you understand how it works, you will be able to apply it to any stock. Now, when it comes to key levels, we generally look at them as levels of resistance and support. But did you know that these same levels are also seen as storefronts? Like a grocery store or a supermarket. If you don't believe me, watch what happens when a stock comes into a key level. Notice what happens to the volume. It increases. This means that buyers and sellers see this area as a place to come together and do business. It's like an untold collective agreement. But why should you care that most buyers and sellers wait for key levels in the first place? It is because once buyers and sellers are happy with their new positions and that fire sale at the key level is over, what you are left with is the start of a new swing, aka the start of a new trend. Now, would you rather get into a trade during the start of a swing, somewhere near the middle, or somewhere near the end? You would rather get in near the start of the swing, of course. If someone enters a trade and no key level is in sight, chances are you are late to the party and a reversal will likely follow soon after you enter. Drawing key levels are simple and powerful, and they can prevent you from being late. Key levels can be horizontal levels, they can be downtrend lines, and they can be uptrend lines as well. Buying at these key levels will reward you with the start of a swing, catching the beginning of the move right when it happens. Let me know if I should make a dedicated video on how to draw trend lines with more examples in the comments. I also have a newsletter where I share the best breakouts of the week from key levels straight to your inbox every week, and you can check that out in the description below. Now, key levels are strong and powerful all on their own. See how WDC gapped down during earnings and conveniently stopped right at a major key level. This is the power and the importance that key levels hold. But this video is about the power of two. We are going to be using moving averages to make these levels even stronger. But that's not even the most important thing. Price may come into a key level, but it might not be ready to start the move. Buyers are still buying and sellers are still selling, and they want to do so at that key level. The big mistake traders make here is getting the timing incorrect. How do we not get caught in the action before the stock is ready to explode? I'll tell you, it's by using dynamic key levels, which we call moving averages. Moving averages are key levels in themselves that don't stay in one spot. And it really helps with timing your entries. When a moving average meets a static key level, big things happen. Stocks explode. But it's important to be patient and wait for both of these key levels to collide. This is one of the highest probability setups ever. And the same rules apply. Moving averages are storefronts that move. Ever notice those spikes into key moving averages where price would dip, kiss the moving average, and then just continue ripping higher in the direction of the trend? That's simply because traders like buying at key levels. It has always been this way and it will always be. The best moving averages to combine with your key levels are the 10, 20, and 50-day moving average. Each moving average can be used individually with a key level buy, and they are even more powerful when they all come together at the same point and get really tight. When one or more of these moving averages collide with a key level, it's time to start expecting the expansion of a move. To get better at trading this setup, start by identifying your key levels, but don't jump the gun too early. More than anything, the moving averages are a perfect tool to help you with your timing. This is very important if you want to enter at the exact moment that the trend is about to continue. If you ignore this, you could end up trying multiple times while getting stopped out over and over, and when the trade actually moves, you might have already lost your confidence. And to prevent that, all you need to do is to wait for that kiss between your key level and the moving averages. Place an alert and wait for the moving averages to catch up to your key level and buy in the direction of the existing trend. How do we know what the existing trend is? It's the direction of your moving averages. For example, if the moving averages are all facing up, you are in a confirmed uptrend and should be taking longs. If the moving averages are moving downwards, you are in a downwards trend and should trade in the direction of that trend. And sometimes these trends can continue for a long time. You, my friend, are now equipped with the tools to find the beginning of a trend using the power of 2. And it's one of the greatest and most reliable setups ever. Ask me any questions in the comments below if you have any. And chances are you're new here, so drop me a like, and why don't you subscribe while you're at it?